I think that's right. It probably is until you get certainty over the path of interest rate rises. So as an internet analyst, I've really become an interest rate analyst. Until we get that stability, I think it's extremely hard, especially for the high multiple price to sales stocks. So the stocks I like here, you have to go with the highest quality consumer tech names. And in my mind, that's Google, and in the market's mind too, I think, Amazon, and arguably Facebook. Or you have to have real recovery plays, you know, the travel names and even the ride-sharing names, although we had some disappointments today from Uber, but that was the case of the market just wanting more upside than the company provided.
So even with the drubbing that Facebook has endured over the past week or so, Mark, it hasn't reached valuations where there is a floor under the stock, even with a rising interest rate environment? I mean, it hasn't reached those value levels yet?
Oh, I think it absolutely has. This thing is now trading at 14 times, 15 times earnings. This is the lowest multiple that Facebook has ever traded at. This is below where it traded during that 2018 controversy. Melissa, you'll remember that well. This is in the wake of Cambridge Analytica, Cambridge Gate. So this is these are trough levels. And for an asset that I think it's got to prove it, but I think you recover to 20% plus revenue growth, recover to almost 30% earnings growth. I don't think, if I'm right about that, I don't think the stock's going to be trading at 13, 14, 15 times earnings 9 months from now. That's why it's a really interesting opportunity here. But I get it. It's for fundamental reasons, not for interest rate reasons. It's dead money for the next 3 to 6 months.
Yeah, I mean, Mark, remind us where you are on Uber here. I mean, you talk about something that's been dead money for a longer stretch of time than that, and a little bit of an adverse reaction to the investor day today.
Well, I think investors and analysts, including myself, had expected them to be a little bit more bullish in terms of their long-term margin guidance. Essentially, they only provided midterm guidance, and they can essentially confirm street numbers. So street numbers aren't going to change based on today, and there's a little bit of expectation, hope that they would. I don't think there's any dramatic change. And I thought there were a lot of interesting data points here. And by the way, I think the valuation on Uber is going to become increasingly compelling. They're essentially trading at around 14 times EBITDA on 2024 for an asset that I think can grow EBITDA, not 10% or 20%, but 30, 40, 50%, you know, over the next several years, because they're starting from a small base. I mean, they're going to quintuple their EBITDA from 2022 to 2024, we're in 3 years, 21 to 24. So that's what's so interesting about Uber. You still need that recovery, and those interest rates are going to be a bit of a headwind here. But I really like Uber. It's one of my top picks for the year, along with Amazon and Facebook.
You know, Mark, when people start talking about a 50 basis point cut, I know that you probably think back to the last time that happened, and that was sort of the final stake through the heart of the NASDAQ bubble. Yeah. Do you worry that will happen to your coverage universe, particularly the high multiple ones, or have we corrected in advance to some degree?
I'm not sure that we've fully corrected. I guess, Melissa, as I've thought about it, you know, this correction that we've seen in NASDAQ, what are we doing here? About mid-teens correction. If you look at, I've lived through 11 of these corrections over the last 20 plus years. The average duration, leaving aside the really big fall-offs like COVID crisis, like the great housing crisis, you know, the typical fall-offs have been 15%. They've lasted for 3, 4, 5 months. We're still only about a month into this. So I wouldn't be at all surprised to see this correction continue, maybe not much greater severity, but certainly in terms of duration for a while. But keep in mind that last crunch we had in NASDAQ at the end of 2018 gave you a chance to step in on names like Amazon, Google, and Facebook, and even Netflix back then, and gave you great returns over the next 12 months. The question is finding that bottom. I think my guess is you're going to have to wait a few more months, but it's going to be in there.
Mark, I mean, if it's just a protracted valuation compression, which, you know, it has seemed to be so far, I think that's one category of correction. But, you know, we talk about, you know, you and I living through the big bust back in 2000. There was a bit of an adverse feedback loop that took hold, right? You had all the IPO money and all the startups and all. Today it would be the cloud software companies raised a bunch of money. And there was this ecosystem that all of a sudden was on the defensive because those companies that started to struggle didn't, you know, they were somebody else's customers. Do we see anything happening like that in terms of spend, in terms of the fundamentals of these sectors?
I haven't seen that yet. It's possible that'll happen. Yes, you're right, Michael. We lived through that. And I remember we had some dramatic corrections in the ad and commerce leaders of the day. But we're going back 20 some years. Today, what just happened? What did we just learn from our Google and Amazon prints? Google's growth rate didn't change. Amazon's growth rate actually accelerated. AWS growth actually accelerated. Like the leading highest quality names, their fundamentals are extremely well intact. So that's why you want to stick with those names, the most offensive names in the space that I cover. in a time when you probably need to be defensive are Google, Amazon. I know Facebook's controversial fundamentally, valuation it isn't, and I'm still going to look for these recovery plays because I think we are going to get out of this. I hope we get out of this Omicron crisis, and then we'll start seeing a real reopening. And there's a few really great ways to play that. Uber is definitely one of those.
Mark, it must be hard to come out and tell your clients that your space is basically dead money for a few months. When was the last time you had to do that?
Well, did you make a good point? What's implied in your point is we haven't had a lengthy re-rating in interest rates. We haven't had a aggressively rising rate environment in 5 years or arguably in 10 years. That's how long it's been since you had to really, for a substantial period of time, call it 3-6 months, really avoid the high multiple names and play defensive and stick with the highest quality names. So it's been a long time, Melissa, no question about it.